Hello, everyone. James here with Urban Elevation Group, and I don't have David on right now. David and I are going to do a podcast a little bit later to bring everybody up to speed on our project at 1232 Rivas, the duplex that we have under development, and we're pouring concrete soon. But I wanted to spend a few minutes with you going over the deals in a little bit more detail, give you some highlight of the deal making that we have going on with the different duplexes and triplexes and ways for investors to come in with us on some of these, and I wanted to be more detailed about it and go over a few deals that we have going on right now. David and I believe in full transparency, and so the deal that we offer to one person is going to be the same deal. We're not tailoring these to different people with just different opportunities that are available, and so we want to talk about those and share those and really tell you about what that means. So let me share my screen real quick, and I will show you. Just to start off, I'm going to give you an example of the triplex that we have. So we have. I'm going to talk about two projects today. The first one is 1703 Burnett, which is the triplex that we have on the east side. Burnett is on that east side area. It's actually an opportunity zone, and David and I will talk about what that means exactly, these economic development areas and the benefits of being in an opportunity zone in the city of San Antonio. But this is a triplex, and I'll talk about the duplex that we have at 122 Eros, which is very close by and on the east side. So just to give you an idea, so this is the lot right here. This was surveyed. It's kind of a long, narrow lot. It's really nice and flat. There's nothing on it right now. It's a vacant lot. You can see it's at 1703 Burnett Street. It has two entryways here, driveways, and so we have a really good designer that will take the survey, and he will place the buildings on the survey the way that they fit, and with the proper easements and setbacks from the city, and basically tailor each project to the specific lot, because our lots are all slightly different in what we're doing around town. We don't have this huge piece of land that we're just placing these on top of each other. So this is a triplex unit A, B, and C. The way these are stacked is one behind the other. These are individual units, so they have a main floor and a second floor. And so I'll show you kind of what that is right here. This is the front elevation here. They have all of our projects are similar in style. They're modern, but modern to the point that it's expensive to build. So they're not uber modern, but they're on the modern side and very easy to build. And so traditional building methods basically. Main level and upper level. So main level in each one, they're individual units here. So top and bottom, each unit has a bottom and a top floor. This bottom floor has a living area, a kitchen area, and a half bath. Stairs that lead up to the second floor for 2 bedrooms and a full bathroom there. So washer, dryer, everything is internal to the building, and so they're fully functional, fully ready for rents or to be sold later at some point. So that is the triplex at 1703 Burnett. So let me talk to you a little bit about exactly what that deal looks like. So this is a projection that David and I use, and we use it for all of our projects for our investors. But you'll see when I talk about the duplex, they're very similar percentages for calculations and everything. But just to kind of explain how this chart works, you'll see that it starts in year 2, going through year 6. So, really the calculations start in year 2 because the first year is just development. It's building the property. It's going to take, if it's a triplex, it might take 7 to 8 months to build it. The duplex might be a little shorter, but everything that has to happen in that first year is happening, and so the projections really kick in on that second year. But I mean, there's equity built in from the very beginning. David and I, we purchased the lots outright. We own them. We bring the lot to the deal, so we're not asking anybody to fund the lots, the land for us. So there's already equity built into the project, and and we buy the lots at a good price, and most of the time they're undervalued actually. So we have immediate equity and immediate appreciation built into these projects. But we start from year 2 here on the projections going through year 6. We have an estimated appraisal value of $160 a square foot. So this particular project is almost 2,700 square feet total for all 3 units. And so each unit's about 900 square feet. That $160 a foot is based on projections, comps in the area. We had a full appraisal done actually on our property on 1232 Rebus, and that's on the near west side, so a little bit lower values there. So we're very confident in that number of $160 a foot for an estimated value. And that's if it's basically if it's completed, rented out, and sold immediately. That's what it would be at the end of year 1, beginning of year 2. So we're looking at $430,560 for that first year's, say, second year appraisal value. And then it goes up. We have a 3% built-in appreciation going through all the way up through year 6. So it starts off at $430,000, ends up at $484,000 because we feel like that area is doing really well. We've seen it appreciate over the last several years, and it keeps on going up. So this is the east side of San Antonio here. Now, if it were to be sold, there's obviously some fees and realtor fees and everything that goes into selling the property. So I have a calculation of 93% built into that. I'm calculating 7% off the total value of that $430,000 going towards fees, and if it were to be sold. So it ends up being $396,115 there is what it would be, what the take home would be after it's sold. Now, the total contributions in this particular scenario, we're asking for $75,000 on a investor buy-in for 25% of this property. So the total contributions from the investor would be $75,000. David and I are bringing the lot. We're doing everything at cost. We're building it at cost. Our build cost here, that $280,000 is really the cost to construct the building. And there's a $10,000 financing fee. So for constructing it, for the construction loan in that first year, we're calculating $10,000. So there's that $270,000 build cost. That's $100 a foot. That's David's company, Sunrise, or an equal type of general contractor building it at basically no profit for us built into the construction of the building. And then an interest-only loan while it's being built for that $280,000. So total contribution from everybody in that end of the first year there is $355,000. Now, this loan actually will go down a little bit every year because once it's complete, that loan gets turned into that construction loan, which is an interest-only loan, will get turned into a long-term, more of a general mortgage, like a 30-year mortgage. And so it is being paid off a little bit year over year. So that number actually goes down by $5,000. Principal is being paid year over year. And that principal mortgage is being serviced from the rental income. And I'll show that here in a little bit. So, but at the end of year 6, then there's only $335,000 owed as opposed to that $355,000 initially. Now here we go into the profits if it's sold without rental income calculated into it. So basically, and year 2 is really where we really want to see that number where it makes sense. So basically here is if that project is built and it is immediately sold after being completed, there's really no rental income that's been accumulated to us as owners, as partners. Then the profits there is $41,115, and that's the profit on the building and taking out all the contributions. So now 25% would go back to the investor, $10,278. That would be added to the original $75,000. So that $75,000 is secure from the very beginning. I mean, it's always there. It's always safe inside the building. It's already part of the equity and appreciation from the very beginning. So that investor would take home, $85,000 if it's just sold right outright. At the end of completion. Now this is where we get into the the net rental income. It gets accumulated over time over the next 5 to 6 years. So that first year rental income is on this particular property here. You see is how I calculated it. 3 units. We've done some comps in that area, and we're saying that each unit would rent for $1,300, which is a very it's a very conservative figure. We wanted to keep everything conservative and not outlandish in any way. So 3 times 1,300 is at $3,900. I did a calculation of 70%, as far as 30% of the fees would be extracted for maintenance, management fees, even property taxes. So the net on that monthly would be $2,730 a month. Now that would increase 3% year over year, and I show that in here also because we would be increasing the rents based on the market value and having renters already in the buildings, or when they come in, we would increase the rent from the very beginning. So that's shown here, and then the total financing here of that $270,000 for the construction. Then I used a 5.2 APR, which is once again conservative over 30 years. Those are the monthly payments there: $1,350, $16,200 annual. So all of that is taken out from the rental income and it's put back into the equation here. There's that $5,000 that's being paid on the original note every year up here, being paid down every year. So all of these numbers are incorporating all the fees, and they're conservative. Here is the total rent for that first year, $16,560 on the total project, the whole property, all 3 units rented. 25% of that would go to the investor at $4,140. That's if it's not sold. That's right now we're keeping the property in this equation here. Now, if it's sold in that somewhere in that second year, at the end of the second year, you've had a full year of rents there, and all the profit from the equity and the appreciation in that first year, you would come home with $57,675 as a project. 25% of that would be $14,419. You would add that to the original $75,000, and that would be the take home for the investor. Would be the $75,000 plus the $14,419. That's if it's sold in that second year with rents accumulated just from that first year of rental income. You can see these numbers really start making sense and looking even that much better through year 6. So we go into, every year that things get better, more rent is accumulated, the notes pay down slightly. So in that year 6 here, you see the net profits on the income of the rents is $115,677. So 25% of that is $28,919. So that's if it's held and kept and not sold. That $75,000 original investment is still in the project. This is just pure profit. Now, if it's if it's sold here with the rental income, all of that accumulated, you get a profit of $208,600 on the project, and 25% of that is $52,150. So, and that's added to the $75,000. So basically, if it's sold at year 6, you've had 5 years of accumulated rent, because the first year's construction, then you have 5 years of full rents accumulated, and you sell it in year 6 as a 25% investor with that $75,000, you can take home the profit of $52,150 and your original investment of $75,000. And that's just a huge profit margin. It's a great investment. It works great for us, for David and my company, and what we're trying to do, and it works great for investors. And this can be kept even longer, and even more rental income would be accumulated, more appreciation on the property. But we stopped at year 6 because this is really what we wanted to show is a 5-year rental history equation. So that's the triplex at 1703 Burnett. Let me show you the duplex just real quick. The duplex is the one that we have right now that we're going into a partnership right now. Is 122 Eros. It's in that same area on the east side. This one is 1,701 square feet. very similar numbers as far as the equations that we use. This is a $50,000 buy-in for 25%. Obviously, it's a smaller building. It costs less to build, so it's a smaller buy-in, but still great numbers here. All the numbers work out to really good rental profits. And that $50,000 is, once again, it's safe and secure inside the building as far as equity. So here, rental income on the duplex, if it's not sold, that first year for 25% of the owner would be 2,460. That's just profit, rental profit. If it's sold in that first year, the proceeds to the investor would be 8,737 plus the 50,000, so 58,737 is what, if it was sold in that second year, that's what the investor would take home. Now, going to year 6 is really what we want to show. If it's held for some considerable time up to year 6. Just rental income alone at 25% would be $13,987. That original 50,000 is still in the building, still being held, growing and appreciating. If it's sold in year 6, the investor at 25% would take home $31,206 plus the 50,000, so $81,206 of total take home. The 31,000 is just pure profit on the original $50,000 investment. So great numbers. Really wanted to just kind of get into detail. Go to our website, call us, urbanelevationsgroup.com. Go see our podcast that we have, and reach out to us. Let us know. We have on our website, we show the lots that we have available. We're consistently looking for lots in a couple areas of San Antonio for ourselves and for investors to come in with us. A great opportunity for everyone to do well and make money over pretty short term. So very exciting time to be in San Antonio doing urban type facilities near San Antonio, near downtown. And just let us know if you have questions. We'd like to meet with you one-on-one, go over the deals that we have. You can buy these, you come in half with us, or you can come in at 25% with a couple of deals that we have. And I think it'll be a good opportunity for everyone. So look forward to hearing from you. Thanks a lot. Talk to you guys soon. Bye.